This is the second video that I have ventured to produce, particularly in the area of financial pitfalls. And I'm continuing what I began in the introduction. We spoke in the introduction about the peril of a false balance and how a false balance is not good. We realized there that wherever there is a mismatch, it can be absolutely perilous for organizational survival and for any type of success. In the light of our speaking of mismatches and their financial impact, what I want to talk about today and what I want to explain in layman's language is something which, well, accounting people are supposed to understand and financial people are supposed to understand, but most of the time they don't. This is the distinction between fixed cost and variable cost. And that is something of significance which actually helps us to manage cash flows and to plan and understand where the mismatch is going to be. See, there is, in finance and economics, we often speak about the short term versus the long term. What we refer to, the number of months or weeks we refer to as short term or long term, could vary depending on the industry that we're talking about, depending on the context that we are referring to. But nevertheless, if we hypothetically imagine that a 6-month time frame or a 3-month time frame, for example, is a short-term period, that is significant to us for this reason. See, if you've taken a place out on rent, there would be a minimum period of notice before you could vacate and leave that building. And that means if that location turns out to be unsatisfactory, if you find that that isn't a suitable place to engage in one's trade, if that isn't a suitable place for the type of sale or the type of business that you have ventured into, you can't pack up in 1 month and tell the landlord, look, I don't like this place, I'm leaving. Because most of the time there would be an agreement which you would have signed before taking that premises on rent. And that agreement would, in very rare occasions, say that you've got to give the owner 3 months notice before you pack up. Most agreements nowadays ask for 6 months notice, which means if you're leaving the building, if you're leaving the premises, you've got to pay 6 months rent as a penalty or as compensation to the owner if you are leaving without notice. So what happens is, if you're going to pay 6 months rent in any case, or if you're going to pay 3 months rent in any case, there's no point leaving the place early. One might as well occupy the building for the entirety of that period for which rent has to be paid as per the contractual obligation. Now, if that is the case, we understand that the rent, depending on the agreement, is a fixed cost for 3 months or even 6 months, meaning in that 3-month time frame or 6-month time frame, there's nothing you can do about that expense. Whether you remain in the building or vacate the building then and there, you've got to pay that minimum stipulated rent which you have contractually agreed for. So that is a fixed cost. And the significance of that being fixed is that at the end of the day, you can't tell the landlord, I'm sorry, I haven't had sufficient sales this month. Neither can you tell the dude, I haven't been able to produce the quantities I wanted to, or my machines malfunction and I haven't been able to produce at all. You know, if you're in the startup stage, you can't say, look, the shipment of machinery that I expected was delayed, or the installation was delayed, and so I couldn't produce anything at all in this month. All that is absolutely irrelevant to the landlord, because if you have promised to pay, you've got to pay. When it comes to executives, when it comes to senior staff salaries, there again, people are recruited with a promise that in the event of their being asked to leave, they must either be given 3 months notice or 3 months salary, 3 months remuneration in lieu of notice. So once again you realize that the basic salaries of your staff are a fixed cost. You've got to pay them whether you like it or not. You've got to pay them whether you've had sales or not had sales, whether you've had sufficient cash flow in a month or didn't have sufficient cash flow in a month. The basic salaries must go. The lease installment, you've got to pay that whether you like it or not. If you've taken a bank loan, you've got to pay your loan installment whether you like it or not. So we realize that in our highly geared structures in businesses, I hope you understand what that means. When we say highly geared, see, there was a time when people would save money over years, and it is their savings that they would put into a business when they start the business. And of course, where the savings fall short and they require some furniture or vehicles or machinery, then they would borrow. But today, the structure is different. In the latter part of the 20th century and through much of the 21st century, what people have done is, well, they have minimal savings, and the money of the shareholders is a very small percentage. And most of the time, 60%, even 70% of the money that is invested in businesses is borrowed funds. Even where shareholders have actually put in their own money, they haven't really put in their savings. Shareholders too borrow. So ultimately, in reality, if you cut through the fog and you look at the actual context, every business is started with borrowed funds. That's a perilous situation. Now, before I get to the peril of borrowing, I need to speak of the peril of having most of the costs in an organization, most of the costs in a business, if they happen to be fixed costs. What that means is that 60 to 70% of your monthly expenses will not decrease in a month where your sales volume actually comes down. So if you have low sales, say it's an off season, or it's a period when generally, seasonally, sales are low, that means that you would purchase less raw material. That means that your production quantity is probably going to be less. So as far as your variable costs are concerned, when I say variable costs, I'm referring to costs such as the cost of raw material, the cost of components, the hourly rates that you may be paying as an additional fee, as an overtime payment for the staff in your factory or the staff in your organization. These are variable costs. Much of your electricity bill is also variable. If you consume more, if you produce more, you would have a higher electricity bill. If you produce less, you would have a lower electricity bill. So that means that when it comes to the variable costs, in poor months, when months where sales are seasonally lower or habitually lower, you will have lower variable costs. And that is a compensating factor, because yes, indeed, you will forfeit the profit margin that you could have made on the usual volumes, but at the end of the day, you've had a drop in sales volume. You'd have a commensurate or a proportionate drop in variable cost. That is not true of the fixed cost. The fixed cost is fixed whether you like it or not. Whether you have high sales or low sales, the fixed cost remains the same. Now this poses a practical challenge. So what do we do about this? Step 1. Wherever possible, particularly remuneration, we must try as much as possible to make sure that a part of remuneration is fixed. That is a guaranteed payment. And where performance, or the performance of the organization, the performance of the individual can in some way be linked to the remuneration, then we can have a scenario where in months where sales happens to be high, in months when you get more money, in months when you have better cash flow, then you pay the staff a slightly higher amount. In months when you have lower cash flow, in months when you have lower sales, you could pay the staff a lower amount. But you would realize that practically you cannot make this 50-50. in practice, unless it's a sales job, where of course we know habitually all over the world, sales staff are paid a fixed allowance, but the rest of their remuneration is pro rata or proportionate to the sales that they have brought in. That is a norm in sales jobs. But in other jobs, in office functions, in back office functions, it's very difficult to even bring a 50-50 split between a fixed allowance or a fixed basic salary and a variable element. So the chances are you'd probably be able to, in most cases, have a 25 to 30% variable element and a 70% or 75% fixed element. Nevertheless, where it is possible, this is something which is worth doing. Of course, things like incentives, bonus payments, if these are involved and if these are part of the package, if these are supposed to be paid at the end of every quarter, at the end of 6 months, that would be a helpful way. If someone wants a fixed amount that they can bank on, maybe you could pay that fixed amount as their monthly remuneration. But that could be slightly lower than what the individual would expect in terms of an annual salary. Let me demonstrate what I'm saying. See, what I'm saying is that we could basically have a lower fixed remuneration, but the incentive, whether paid quarterly or once in 6 months, that incentive could be performance based. That incentive could be based on how the organization has fared in that particular quarter. And that would make sure that we don't commit ourselves to a cash outflow which we truly can't afford. One more thing before I conclude this video. We know that sales is variable, but there was an Italian mathematician who once explained in the context of countries how 80% of a country's wealth would oft belong to 20% of its population, and vice versa. The 20% of its wealth would be spread out and distributed among 80% of its population. This rule is equally applicable in the business realm. When I say it's equally applicable, we find that in most businesses, 80% of the sales is attributable to approximately 20% of the customers, whereas 20% of the sales is attributable to 80% of the customers. Now, with that in mind, we would realize that we actually have a handful of key customers. A handful of key customers who account for 70 to 80% of our sales per month or our sales per quarter. If these customers can be identified, and with these key customers, if we can come to some sort of contractual agreement, if we can come to some sort of contractual guarantee where there will be a minimum quantity that they pledge, and in return for that minimum quantity that they pledge to order from you on a monthly basis or a quarterly basis, you could probably work out some sort of discount which is exclusively for these key customers. And that would be an incentive for those customers to get into a contractual agreement where they more or less guarantee a minimum quantum. Now, if they do that, what you have done is that probably you can't do it for all 80% of your key customer sales. Maybe for 40% of your sales, which would be attributable to 10% of your customers, that you may be able to get some sort of contractual binding, some sort of contractual bond. If you do that, what you have then achieved is that you've made variable sales, seasonal sales, less seasonal and less variable. In other words, you've begun to bridge the gap between costs which are predominantly fixed and sales which are predominantly variable or entirely variable. See, if you have no contractual obligation, if you have no contract with any of your customers, if they haven't pledged a minimum quantity, what that means is that your sales will perpetually be variable. And you have to cope with variable sales, which will be an utter mismatch to 60 to 70% of your costs, which would be fixed. So I'm not talking of a perfect world. These mismatches cannot be eliminated in entirety. But if we are prudent, if we understand where the pitfalls are, if we keep our eyes open, you can attempt to minimize or reduce those mismatches. And if you do, you will save money. You will ensure that your organization survives, and it must survive if it is to thrive. Stay with me. Check out the third video as well, as we continue to learn about the perils of a false balance and how prudent balances or good balances will save us from financial pitfalls. All the best to you.